Good afternoon, all. We thank you for taking out time to join us on construction webinar series. This is chapter 1. It's 4:01. We are seeing number of attendees joining the call. Very shortly from now, we will start the webinar. So it's 4:02 now. Good afternoon once again, everyone. While other people are joining the call, considering the time that we have in hand, we'll start the webinar. I'll hand over this presentation now to Sanjay sir to kickstart our series of webinar with chapter 1. Over to you, Sanjay sir.
Thank you, Abhishek. Hello, everyone. Welcome to the Marsh India webinar on construction insurance. I'm Sanjay Kedia, country head and CEO for Marsh India. I really appreciate you all joining in. We have a very impressive set of panelists, and which I'll introduce them very shortly to all of you. Why a webinar on construction insurance? Couple of reasons. One, we've had a number of our clients engaging and interacting on several technical issues regarding construction insurance. I believe we have some of the best speakers, both from the Asia region and our global leader, all on the panel. It'll be good to engage them. And we intend to commit to a series of webinars on technical issues pertaining to construction insurance. These webinars will be highly interactive, where you have an opportunity to ask a question, share a viewpoint, and please use the question answer tab anytime during the webinar. You don't need to wait till the panel members make their comments. Your questions can keep pouring in. I'm also pleased to share that Marsh Construction Practice is a very joined up global effort. We have regional global experts available to work alongside India colleague team. Abhishek, who leads our construction business practice for Marsh India, and all of them are available not only during this webinar, but if you want to set up a one-on-one meeting with them, they would be available. And it's a very joined up efforts. And I think this webinar is one of the opportunities to interact. So quickly introducing our panel members for today. Richard leads our construction practice globally, based out of UK. Stephen, based in Asia, leader of our construction business for the Asia. We have John, who leads client development. We have an advocate, a legal brain on our panel, Sinyu Ong. And I have my colleague from based out of Chennai, Harish Natarajan, from the Consulting Solutions on the Marsh Advisory. So very diverse panel with different experiences. And I'm sure we will have a very engaging conversation. I can share one or two experiences of mine, which I'm quite excited. I'm sure those will get covered. I used to be a banker before I came into insurance, and I used to work on project finance. And I remember as a banker, we always used to grapple as to how do you deal with this, when is the construction insurance getting over and when is the operation insurance starting? You look at the EPC contract, they have very different clauses with regard to testing and commissioning. And you look at the insurance contract, and many times the insurance contract would end much before the construction contract is ended. And it's quite scary. The values are at the highest level during the end of the project, and you don't want construction insurance not to respond at the time when you need it the most. So these are some of the challenges. The issues of contract certainty, force majeure has even gained more importance during pandemic, but always they remain highly relevant and more so on a construction business. So these are some of the subjects and many more which will be discussed. Of course, the importance of risk management as to how you can manage your risks more efficiently, which will get you in a better shape, not only on your insurance, but also on an overall basis. So I think there are lots of interesting subjects. I will leave it to the experts. And more importantly, I hand over to my colleague, Abhishek, who would moderate the panel. And I encourage each one of you that if you have a comment, please shoot in the Q&A tab. And if you want to speak, we'll try and get you live on the screen. Just raise your hand on the panel. I know all of you know by this time how to use the Q&A tab and raise your hand. So please use them. So back to Abhishek. And I hope we have a good session today. Abhishek, over to you.
Thank you, Sanjay, for addressing the entire participants. Before we start the session, the central theme of the session is construction insight on relevance of contract certainty, transition from project to operations, including risk management. Basis global forecast, global construction market is expected to grow by US 4.5 trillion over the last decade to 2030 to reach out to US 15.2 trillion. China, India, US, Indonesia will account for almost 60% of the growth, while the top 10 global construction market are expected to account for almost 70% of the growth over the same period. A further wave of increased demand will derive from the accelerated infrastructure investment support by large government stimulus program aided to boost economies post-COVID. We are very proud to say that India is expected to become world's third largest construction market by 2020. With this, now we will start the session with first poll question, and I would encourage all the participants to participate in the poll. Which of the following is the most common problem while complying with the insurance clause in the contract? Not sufficiently detailed to ensure adequate protection, allocated insurance responsibility not in line with the lender's provision, gap or overlap while designing the risk transfer philosophy. I'm sure all of us would have faced somewhere or the other some of the challenges, and I would encourage everybody to participate. So thank you. While we all can see the results in front of us, you will see that all these parameters are important and has to be addressed when we are drafting a contract. As it is evident from the responses we have received, it is very clear that all of us are fully aware about the challenges and importance of contract drafting. All our endeavors today are to help our participants focus more on importance of why and what of contract certainty. I would now welcome Mr. Stephen Borrington, Regional Managing Director, Construction Practice Asia, to take us through the section on contract certainty. Over to you, Stephen.
Okay, thank you, Abhishek, and thank you, Sanjay, and pleased to see everyone joining us this afternoon. I wanted to present on contractual insurance requirements and share with you a little bit of my experience of some of the issues I've come across and the problems that I've come across in my experience. So just turning to the first slide, I've worked in Hong Kong and in Asia for just over 13 years now, and sort of in my experience here in Asia, the methodology or the construction insurance procurement decision-making process is based predominantly on what the contractual insurance obligations are. So very much based upon whatever is put in black and white. Now, of course, whatever is in the contract will come across some procurement and cost implications that need to be understood in advance of the tender submission. So some of those issues are the required insurances available at commercially reasonable terms? Will the insurances continue to be available at time of contract execution? And in the current insurance market, that can be problematic. What are the implications if it's not possible to comply with the contractual obligations? And that can be problematic depending upon who your employer is. And will the cost of compliance with insurance obligations impact the competitive position if you are competing with other contractors who have a different approach on construction insurance procurement? Now, I mentioned, on the next slide, please, I mentioned that this is my experience in Asia. Now, the approach outside of Asia does differ, and what we see, and based upon my experience in Australia, in UK, in Europe, in North America, is that there's a preference of contractors to utilize annual insurance programs that are designed to address the majority of the contractual insurance requirements. It's a cost-effective approach, and those costs are readily known at the time of tender submission. So there's not the necessity to go out and price all of the insurances, because they would, in the main, be covered by this annual program. Now, of course, for larger projects, for joint ventures, there still may be the need for procurement on a project-by-project basis, but that is more the exception rather than the rule. So now, on the next slide, just talk about what the insurance obligations should reflect. Now, in my opinion, they should reflect or be consistent with insurance market practice, but then also construction market practice. They should be based upon the anticipated project risk exposures. Now, of course, that may not always be the case, and I've included here a project risk mapping exercise, which we have done with clients before, to identify what are the major risks, where you can determine perhaps what the insurance program should be in the absence of a contractual requirement. But the final point I make there is the obligation should be clear and easily understood by all parties. And unfortunately, in my experience, that's not always the case. And a lot of time can be taken in order to understand what is required. And it may not be that easy to determine what is required. So some of the, next slide, please. Some of the issues in my experience that have arisen are things such as the requirements not being able to be achieved in the current insurance market, or can only be achieved with significant premium spend, not reflective of project risk exposures or insufficient coverage for the project, specified deductible levels which are unrealistic or not achievable, allocate responsibility that's not commercially correct. Of course, as contractors, we'll come across scenarios where there is owner-controlled insurance, and the question needs to be asked, is that coverage sufficient? Is that coverage adequately addressing the natural catastrophe exposures? And the map on the right-hand side, or the diagram on the right-hand side here, is a typical NatCat assessment. And in the current market, what we're finding is that NatCat cover is becoming more restrictive. Of course, there can be poor and inaccurate advice to the owner in contract drafting, and that needs discussion. And then the problem is post-contract execution, the difficulty of changing a contract. So imperative that it's reviewed in advance of execution, and really reviewed in advance of tender submission. So on the next few slides, I wanted to share with you some experience of problematic contractual requirements that we've come across. The first one is a Singapore residential development contract. And you can see on the right-hand side a press release about a court award for a personal injury to a cyclist, a third party, that was awarded 8.65 million Singapore dollars. Now, the original claim in this case was 26 million Singapore dollars. Now, of course, original claims can be higher than what the eventual settlement is, but this is, to my knowledge, the largest personal injury claim in Asia. Now, what's interesting in this scenario is the construction contract stated that the contractor must arrange at least 1 million Singapore dollars of third-party liability insurance. And that's what the contractor did, exactly $1 million of coverage. So a shortfall of $7.65 million, plus, of course, legal expenses in addition to that. The contractor was deemed 100% liable. So really, they took that excess cost to their own account. Now, the lesson here is obviously the contract was inadequate in terms of the insurance obligation, but buying excess layers of third-party liability insurance, it's readily available and it's very cost-effective. So to resolve that potential exposure would have been relatively not a great expense to the project. Moving on to the next example, this is my experience from Australia, where we're involved with a PPP project or a project finance arrangement. Now, we had many meetings, as you do with PPP contracts, with lenders and insurance advisors, multiple lawyers and so forth. And we had a very detailed set of insurance obligations, which applied both to the contractor, but then also to multiple subcontractors that were to be engaged. Now, when it came to financial close, and we needed to demonstrate compliance with contractual obligations, it was a very difficult process, very difficult to manage, very difficult to administer, on the basis that a lot of insurance responsibility was transferred to subcontractors. Now, my lesson from this was, despite the fact that we had multiple people involved, really you need to keep it simple, and the main risks should be retained with the contractor. My third example here is, again, an insurance allocation example. And this is an example back in Southeast Asia of a airport terminal runway expansion project where there were 28 separate contract packages awarded to 28 separate individual contractors. So 28 packages, 28 separate insurance policies, insurers, policy excesses, an issue in terms of most packages having different completion dates, no clarity over who was responsible for completed works. And as it was a project that was adjacent to an existing airport operation, an issue over covering airport aviation liability, which was typically excluded by most insurance companies. Now, in this case, realistically, this should have been an owner-controlled insurance program, which would have provided one single policy covering all works, one policy, one insurer, or one group of insurers, one policy excess, and the coverage would remain in place until overall completion. My next example concerns professional indemnity, and this can be particularly challenging in the market, particularly where the obligations are not correctly drafted. And I've included two examples here. The first example is where the policy limit is based upon required to be arranged for an amount which is equal to the contract value. Now, the policy limit in professional indemnity, because of the cost, because of the market availability, it is really based upon a cost risk exposure analysis. And rarely do we see this based upon the full contract value. And rarely could we imagine that a scenario whereby you would lose the entire project as the result of a professional indemnity claim. On the following slide, I have another example of the same requirement here, a little bit hard to read, but this says here, the insurance shall be for a limit of not less than the total contract amount. So again, too high, in my opinion. And what's interesting on this example here on this slide is in this placement, Southeast Asia, there was actually a contractual limitation of liability for the contractor for 20% of the contract sum. So notwithstanding a limit on liability, they still insisted on having a substantial level of professional indemnity insurance. So not a very well designed requirement. The next slide, also on professional indemnity, refers to, and if we go to the following page, another extract from a contract. Two issues on this policy. First of all, if we just go to the next slide, the requirement here is for the policy limit to be, this is in Qatar, and the amount was 200 million, so about 50 million US dollars for any one claim or series of claims arising out of one occurrence. So the first issue there is the policy limit is only ever based on an aggregate basis. And then second of all, the requirement here is for a period of insurance of 10 years post issue of the performance certificate. So the obligation became 17, 18 years on a policy limit that was impossible to achieve. And we had multiple rounds of negotiations with the employer to try and resolve this problem. They weren't prepared to accept an aggregate limit without a higher overall limit with multiple automatic reinstatements. And the cost to comply with this requirement was much more than what was included in the tender or included in the contract execution. So very difficult obligation and a very difficult owner who did not want to change, accept any alterations. Now, the final example I have here, and you may have come across some JCAR funded projects, and JCAR funded projects have very specific requirements concerning employers' risk. So the employer assumes certain risks. Some of them are covered by constructional risk, not all of them, I will say. But the requirement in the tender, in the contract document, as you'll see in the first point here, 18.2D, is there's a maximum cap of deductible for employer risks. And this one here was 30,000 US dollars. We've seen other scenarios where the deductible is required to be nil, but certainly there's an expectation that a lower deductible will apply in respect of employer risks. Now, on the next slide, just some points here. Employer risk deductibles should be the same as contractor deductible levels. The insurance market will not make any differentiation between who's taking the risk. And this approach is not consistent with market practice. And it's difficult, if not impossible, to provide a compliant insurance program. And as you may have come across JCAR funded projects, they are very difficult to change their obligations. And this is a very difficult area of compliance. On the next slide, I've made some comments here about lender expectations. And certainly when we have project finance, privately financed projects, we will find more detailed insurance obligations. We might find more commonly it's the owner-controlled insurance program approach, additional obligations in terms of delay in startup, sabotage and terrorism, for example. But certainly this can multiply by 2 or 3 times the level of insurance advisory engagement that you'll have for the project insurances. So just in conclusion, on my final slide, 2 slides here, in my view and based upon my experience, contractual insurance requirements should be viewed as the minimum levels of coverage. You should consider procuring additional insurances to reflect the potential risk exposures. And of course, during construction phase, risk of loss, third-party liabilities rest predominantly with the contractor, not with the owner. Where there's a scenario that the owner may be arranging the project insurances, you should consider contingency coverage, what we call difference in conditions or difference in limit, which is described in this diagram here. I really believe that there should be some engagement with the project owner where there are problematic requirements to negotiate alternative solutions or clarify what their exact requirements will be. Where possible, tender submissions should be qualified to identify issues in terms of insurance requirements and what has been incorporated into the bid submission. But in the final slide, I would just like to make the comment that ideally you should seek advice from an experienced construction insurance broker or advisor. And my point that I would make here, and I would love to stress many, many times, is that it's never too early to engage with your broker. The earlier that we're involved, the earlier that we can provide some advice and help you with a tender submission or a pricing issue. And it is one of our key service deliverables. So never think it's ever too early. It's better too early than too late. Thank you.
Abhishek, I think you're on mute.
Sorry, I'm sorry. Thank you, Stephen, for the insightful session. And I am sure all participants will agree to your thoughts that contractual obligations should have consistency with insurance market practice, should take into account anticipated project risk exposure, and last but not the least, it should be clear and easily understood by all parties. As we are dwelling upon the major aspect of the contract and how important it is to comply with the conditions, we will now be able to not be able to end the topic without touching upon the force majeure clause. I would like to welcome Ms. Singi Yong, who is an advocate and solicitor and represents Sharp and Jagger LLC at Singapore, to refresh our knowledge on force majeure clause and its importance in the contract. But before we do so, we have a quick poll question to run and would again encourage all the participants to participate in the poll question. The question is, what section of the contract provides a remedy for non-performance of contractual obligations in situations which is beyond the reasonable control of the parties? Is it preamble or scope of works? Is it force majeure clause? Or is it liquidated damage for delay? Wow. So now we all understand that the importance of force majeure in the contract and its relevance. So I'll request Ms. Singing Yong to take over the presentation.
Thank you, Abhishek. Good afternoon to everyone, and thank you very much to the Marsh India team for organizing today's session, as well as inviting me to speak. So for this part of the session, I will talk about force majeure, and I'm quite sure, judging by the 82% of you who have for the force majeure clause, I think you would have been aware or have heard of or have used, the force majeure clause at some point in your career. And what I really want to do in this section of the webinar is just to point out some misunderstandings, and hopefully at the end of this session, you would walk away with a better understanding of the force majeure clause, how it is to be applied, in what situations would it be considered a force majeure event, and what are the remedies following a force majeure event. It is important not just for the contentious construction aspect, but also in terms of insurance. Sometimes there's coverage if there's a force majeure event and if the contractor has fulfilled the force majeure clause as well. So if we look at this slide over here, the most common misunderstanding we have seen is that a lot of people think that force majeure, the concept of force majeure is like the concept of murder. So they think that murder, the definition of murder and the punishment for murder can be found in the penal code. And a lot of people think that, well, force majeure works in pretty much the same way. You can find some kind of legislation somewhere that gives the definition of force majeure as well as the remedies when a force majeure event occurs. Now, that is a misunderstanding. In common law jurisdictions, including Singapore and India, there is no legislation for force majeure. Instead, force majeure is pretty much a contractual construct. So what this means is that you have to provide for the force majeure clause in your contract. You have to state what are the events that are force majeure events. You have to state what are the reliefs that you get if a force majeure events occur. If you have a well-drafted clause, then if a situation occurs, you may very well get a relief. But if it's not a well-drafted clause, then tough times, you may be in very difficult waters at that stage. So if we move on to the next slide, the question then is, what are the sorts of situations that are beyond the reasonable control of the parties? Well, the answer is that I can't tell you. It depends on what the parties have decided. And that is what has to be drafted into the contract. What is a force majeure event? What are the remedies that you get when you have a force majeure event? And what I will do in the next 3 slides is to show you some examples of force majeure clauses. So in this slide, you would see that it actually has a very well drafted force majeure clause. There are 2 parts to it, the first half and the second half. So the first half provides us with a definition of what would be deemed to be a force majeure event. So these are usually events that are beyond the reasonable control of the parties, could not have been reasonably foreseen by the parties, and could not have been reasonably avoided by the parties. So this is, in this force majeure clause, this is a definition of a force majeure event. And then if you look at the second half of this clause, it provides some examples for the types of events that would be classified as force majeure events. So for example, war, terrorist attacks, natural catastrophes, those can be classified as force majeure events. But what we need to keep in mind is the words that are in the blue box, which is but it's not limited to, because but it's not limited to means that the examples you see in the 4 bullet points in the lower half of the slide, they are not exhaustive. So if you have an event that you're not sure whether it's a force, that is not listed and you're not sure whether it's a force majeure event, then you look back up to the first half of the definition. So let us take an example. We spoke about the pandemic and we are still pretty much living in the pandemic today. So sometime last year, a client came to us and said, well, I'm unable to complete my contractual obligations because of the pandemic. But they have a similar clause like this, but then they said, well, there's no pandemic, there's no epidemic, there's no virus, there's no disease in this clause. So am I covered? Well, the answer is, well, probably yes, because if we look at the first half of this clause, a pandemic would be something that is beyond the control of the parties, that couldn't have been reasonably foreseen by the parties and could not have been reasonably avoided by the parties. So it pretty much falls within the definition of a force majeure event, and it would more likely than not qualify as a force majeure event. And then if we move on to the next slide, this is another example of a force majeure clause, but it's slightly different from the previous one. So the previous one, it was split into 2 halves. The first half, you see an overarching definition, and then the second half, you see examples. For this one, it's just 1, 2, 3, 4 examples, the first 4 bullet points. And then you see the last bullet point, it says any other causes beyond the reasonable control of the parties. So if we go back to our pandemic example, then we ask the same question. Well, we don't see pandemic in the first 4 bullet points. We also don't see an overarching definition for what constitutes a force majeure event. So does it mean that if pandemic doesn't fall in the first 4 bullet points, isn't similar to any of the first 4 bullet points, then it's not a force majeure event? Well, The answer is, well, not really, because in common law jurisdictions, under the common law, if you have something like the last bullet point, then the meaning of any other clauses would have to be interpreted in accordance to the wording of the contract, which is that if you have an event that is beyond the reasonable control of the parties, then it is a force majeure event. And if the pandemic is beyond the reasonable control of both parties, then it's more likely than not, it will qualify as a force majeure event, and therefore you will get force majeure relief. Now, we have touched on, just back to the previous slide, so we have touched on situations that qualify as force majeure events. But curiously, we have also seen clauses where we see a lot of the word force majeure being used in the contract, and then we see like clauses like force majeure will excuse parties from doing X, Y, and Z, from completing on time or on cost. But then you look around the contract and you see a lot of reliefs, but you don't see a definition of force majeure. So if that's the case in your contract, then be very careful, because you may think that you are likely to get some kind of relief if force majeure occurs, but the truth is that nobody would know what is a force majeure event, because there is no definition of force majeure. So if you have got sort of like a half force majeure clause, it has half of it, but not the other half of it, then you don't really have a force majeure clause. Now, if we move on to the next slide, so once you have defined a force majeure event, then the next question is, what are the reliefs? And in construction contracts, the most typical types of reliefs are extension of time for completion of the project and reimbursement of additional costs to complete the project. Again, this would have to be explicitly stated in the contract. If it's not, then even if you have a definition of force majeure, you have no relief even after you have identified what is a force majeure event. Now, if we move on to the next slide, so as I said earlier that sometimes insurance coverage kicks in instances of force majeure, and parties would need to, and the insured would need to show that they have fulfilled the force majeure clause before they can fulfill the insurance claim. So in addition to the definition of a force majeure event, it is very important to note that oftentimes the force majeure clause comes with all sorts of requirements that you have to follow as well. So the first one is the notification requirement. So usually there's a requirement to notify the other party within, say, 14 or 21 days of becoming aware or should have become aware. So what you need to keep in mind for this requirement is the should have been aware part, because even if you're not actually aware, but you should have been aware, then your clock starts ticking from when you should have been aware. So for example, if the government announces on the 1st of December that construction sites are to be closed on the 7th, and for some reason you don't know about it until the 7th, you go onto the site and then you realize it's closed. Now, because it's a public announcement, you probably should have known about it on the 1st. So the clock starts ticking on the 1st instead of the 7th. So you have to be very careful, because when you have a very short window to notify, 14 or 21 days, you don't want to end up being outside of this very short time limit, because oftentimes the time limit is a condition precedent. So if you do not notify within this time limit, then you lose your right to claim and you do not have the claim anymore. And also bear in mind that the notification requirements sometimes come with specific formats of notification. For example, written notification. So oral notification or WhatsApp notifications may not be good enough. You may very well have to provide the notification in writing by letter, transmitted through the required modes of transmission. And then the next requirement is the mitigation requirement. Again, it is very common for force majeure clauses to have a mitigation requirement. And that means that you have to mitigate the effects of the force majeure event. So if, say, for example, you have a civil protest and that prevents you from working on one section of the project, but you can redeploy the personnel such that they work on another section of the project, then you should make such redeployment, because if you don't, and you incur 100 days of delay because you don't redeploy them, but you would have incurred only 50 days if you redeploy the personnel, then your relief may be limited to only 50 days instead of the 100 days. Now, if we move on to the next slide. So this is just a very quick summary flow chart to show you, to summarize what we have talked about earlier. There are usually 4 steps to every force majeure clause. The first is to check whether the situation falls within the definition of a force majeure event. The second is, if the first is fulfilled, then you move on to the second step to check whether the force majeure event caused the inability to perform the contract. Sometimes the force majeure event may be a concurrent cause with another cause. And if that's the case, then you may need a delay expert to calculate how much of the delay was actually caused by the force majeure event. And third, you've got to make sure that all the notification requirements are satisfied. And finally, if there are any mitigation requirements, you have to make sure those are satisfied as well. And if those are the 4 requirements in your contract, then make sure that you fulfill all 4 of them, because if one of them is not fulfilled, then the claim may very well fall away. And finally, the last slide has a lot of words on it, but the most important thing to take note of is to always keep documentary records. Force majeure claims, whether in the construction or the insurance context, may be contested by the other party, whether it's the owner or the insurer. So the best way to show that you have fulfilled all the requirements of the force majeure clause is with documentary records. So if you think you have a force majeure event, you think you have fulfilled all the steps, keep all the documentary records, because more likely than not, you're going to have to use them later on. And that's pretty much all from me for today's session. Thank you very much, Abhishek and Marsh India team.
Thank you, Sydney, for your session. I am sure all the participants would have gathered some key points made by you regarding notification, mitigations, documentation, and onus of proof in case of force majeure. Thanks a lot. Now, I would like to take an opportunity to address one of the largest discussed points between an advisor and a client. That is, what are the factors that needs to be evaluated during transition from a project, from construction to operation. We have with us Mr. John Harrington, Sales and Construction Industry Leader, Asia, to share his thoughts on this important point. But before we do so, we will go to a poll question. What is the most common concern during the project handover? Are they the punch list items, or owner doesn't agree to take handover at times? Not sure when to end a project policy and start operations? Thank you. So I'm sure, John, this result will take you through the outcome that is going to come from your presentation. So over to you, John.
Thank you, Abhishek. Okay. Now I must apologize. I have tried to limit the number of slides, but obviously this is very busy and there's a lot to take in. I appreciate the participants actively responding to the poll question. And again, picking up on the 60% answer for the last point about not sure, I think leads to, again, a lot of the input and advice from others, including Stephen, around the early input and interpretations of the various contracts. Now, it's not just the EPC we've got to look at. So again, if I may, and I don't want to just read verbatim the words, we have white papers on this subject. We'd be happy to discuss it further, but I guess ultimately the devil's in the detail, and that is the contract terminology. and therefore it needs to be actively shared with everyone. So this interface itself has historically occasioned a number of disputes and uninsured losses, I think is the right word here, that occurred on the cusp of transfer. Difficulties have arisen simply because of those uncertainties. Operational activities occurring during construction, piecemeal and phased handover of equipment with uncertainties, activities of operational personnel on site during construction phase, revenue being generated before handover is quite common, particularly in energizing power plants or even renewable projects nowadays. Different contractual obligations between or regarding the handover, particularly in regards to the EPC versus the loan agreement and the power purchase agreement. Lack of common understanding between the insurers. Continued and frequent late notifications, which was obviously referenced earlier in times and notifications, extensions, force majeure, everything that can occur. Obviously, potential delays in completion of claims and all of those negotiations. Ultimately, it comes down to, or simplicity, or simplistically, successful testing and commissioning marks the point at which insurance cover may transfer from a contract works program or CAR, contractors all risk, to an ISR or industrial special risk policy. However, there are a number of critical considerations and aspects to be considered themselves. So next slide, please, and I'll try and walk you through some of it. So graphically here, it looks fairly simplistic in return to all of the testing commissioning being completed. However, as you appreciate, and this probably when referencing hot testing and feedstock introductions could well be, let's say, the kit being energized, strings or sections being energized, things of that nature, power being produced. So as you can see there, there's quite a lot, but ultimately it comes down to not just an interpretation from the construction insurers, it's ultimately about what is the testing and commissioning clause that defines what the project is ready to be transferred. So next slide, please, and I'll walk through some of the details. So the operational testing commissioning clause, in the past, insurers were always ready to accept that the owner themselves had accepted the plan and it was ready to go operational. However, there was a number of high-profile losses that transpired that the plant themselves or individual items thereof had not been fully tested and commissioned. Thus, the insurance was in dispute and therefore there were uninsured losses. Operational underwriters therefore ultimately developed a testing and commissioning clause which sought to define the conditions, which must specify how the plant itself is to be handed over or ready to be handed over. These clauses vary from various forms, but essentially encompass the following criteria. Mechanical completion, including testing commission, has been completed. There's been performance testing that conforms with 100% design criteria, maintained for the entire plant in a stable and controlled manner for the continuous and ongoing period of 72 hours. The plan has been fully accepted by the owners following a formal handover and acceptance without reservation or waiver of guarantee conditions. Any deficiencies identified during the testing, commissioning and startup that may affect mechanical integrity process have been rectified and declared and the operation to the operation insurers prior to attachment. Even if there is no specific clause present, the operational policy in question, these criteria are implied and conforming and compliance with such should be sought before attaching cover under the operational policy. Next slide, please. So it looks quite easy. On the left here, you can see here, everyone talks about wanting a seamless and dovetailed approach from construction to operational phase. Again, remembering that there was a requirement for contractual mechanical completion, testing, commissioning, performance testing to 100% for 72 hours, official acceptance. However, as you can see there on the right, we know in reality, and all of you contractors listening have seen this, where the reality is in contract in itself is quite complex. So next slide, please. So the potential challenges to the transition are not only most simple level, but problems can occur when one of the reference criteria cannot be met. The most common of these, of course, is the 100% cannot be achieved for the duration of 72 hours or as prescribed. This can be for a number of reasons. That is no or conditional offtake, which limits production rates, insufficient feedstock, obviously relevant to or energy projects where feedstock's introduced, plant performance not meeting the design criteria, project may not lend itself for 72-hour performance testing, the EPC contract may not require demonstration of 95% criteria, whereas insurance requires 100%. So again, anomalies between insurance and the contract. These all need to be disclosed and agreed between the parties. Other challenges which prevent transition will include warranty items not being declared or resolved, reservation or punch list items not being cleared, or the punch lists not being managed efficiently for a variety of reasons. Next slide, please. So, how do we rectify all this? Again, I apologize, it's a very busy slide. And I do have a couple of other little chestnuts to add, because our renewables team, particularly in regards to some of the renewables projects, have just introduced some new wordings, which I'll touch on. So the transition itself, key phase to avoid problems we recommend. Agreement between all parties on the key transition from cold testing, hot testing, commissioning and startup. A continual proactive awareness of any challenges in schedule throughout the period, and the provision of progress reports, ideally quarterly. Continuous or consistent language incorporated into the construction and operational insurances, and the flexibility to allow for changes in the schedule. The appointment, importantly, of the operational broker not less than 6 months prior. And again, that's not a hard and fast rule. As Stephen touched on earlier, the earlier the better, and the broker can be proving his worth, that thus to interpret not only the contract obligations, but make sure that the insurers from both sides are in agreement. The workable solutions then. The selection of the most appropriate solution depends very much on each case. There is, in essence, 3 main solutions. Extend the construction phase policies, obtain operational insurers agreement to accept the plant in its present state on either restricted terms, or to be removed later once all of those obligations are met. Or likewise, obtain operational insurers agreement to accept the unaffected part of the project, with the balance remaining with construction insurers, typically referred to as partial handover. Given the current market conditions, and this is probably very relevant nowadays, given the current market conditions in both construction and operational markets, any of the above solutions are likely to be challenging. However, the key to accepting or assessing the solution in each of these cases is basically early notification, allowing sufficient time to negotiate. And that means a lot of time. Things aren't easy nowadays to get these things resolved. So therefore, no surprises, and active engagement, contract language, everything shown to and disclosed. The more technical details provided to the insurers, the better. Clear understanding of the actual situation, provision of detailed technical information, and the assistance of your broker, bringing the insurers into partnership with yourselves, knowing full well there are typically different insurers managing both the construction phase and operational phase. What I did want to touch on before I close out and hand back is that some of the latest developments, our new Marsh Sun and that Marsh Wind wordings, they're proprietary wordings that are soon to be launched for both obviously solar and wind farms, will actually include not only first year operations cover for property damage, business interruption, and combined general liability, but they will also provide an early power generation section under the DSU, or delay and startup for the operators in there, in the room, which is basically contract works cover triggering the BI section. So with that in mind, I'll hand back to you, Abhishek.
Thank you, John, for a detailed session, emphasizing on the requirement that needs to be taken on priority while transition of a project from construction to operation. We also take note of your key points that early notification, clear understanding, and detailed technical information is a must. With this, we come to the second last session of the webinar. I'm just conscious of time, but still the webinar that will address why risk management is very critical for a construction project and how proactive risk management will help client manage a healthy portfolio with a controlled loss ratio. To take this session forward, we have Mr. Harish Natarajan, Consulting Solutions, Marsh Advisory. Before that, we'll have a quick poll and then we'll hand it over to Harish to take us through the session. For a client, asset creator, what should be the critical goal while building an asset? Build the asset to code or build the asset to last? So Harish, with this result, over to you.
Thank you, Abhishek, and warm greetings to all colleagues and clients here on the webinar. So very happy that 81% have chosen business resilience. For an asset creator, it is very important to be very resilient. We want to build an asset that will last for ages, and construction industry experts and EPC contractors have a great role in helping the asset creators principle to become business resilient. Now, one of the proven formula to be business resilient is proactive risk management. Now, proactive risk management starts from day one when the asset is conceptualized, and it has its benefits. Time and again in history, it has been proven that principals and clients who practice proactive risk management and adopt it, experience fewer losses, lower cash flow volatility, and more consistent and stable shareholder values. You have two statistics laid out to you in front of you. The graphical representation is basically from a global property insurer, wherein in the past 150 years, what they've seen is based on their loss experience in terms of property damage and business interruption for operational assets, clients who practice proactive risk management have had lesser losses. That figure is represented on the left-hand side, and the one on the right-hand side is for clients or asset owners on the opposite side of the spectrum. Now, that is very self-evident. Proactive risk management has its benefit, and as EPC contractors, architects, PMC managers, you all have a great role in helping clients and principals on their journey towards business resilience. And from the poll question, code compliance is always the start line, and business resilience is the kind of destination stroke journey. So we can move on to the next slide. If you still think these statistics are more theoretical, a live example where a principal had to burn their fingers and then become proactive. Here you see an image of a fire loss at Atlanta Airport in US. This is the busiest airport in the world, ferrying around 100 million passengers every year. Now, there was a fire incident in the underground cable tunnel, which took out the primary power supply lines. Unfortunately, though the airport had a redundant secondary backup power supply line, the power cables, transmission cables for this was also routed through the same tunnel. So the fire in the primary power supply also took out the secondary power supply lines. Now, this resulted in almost 11 hours of disruption, world's busiest airport, and especially during Christmas time, 4 years before. 1,100 flights were cancelled. 30,000 passengers were left stranded without water and no light. And if this happens, let's say to an asset creator, a mission critical asset, the regulator, market, and the customer are maybe unforgiving. So this is something that as an insight could have come up during the project stage itself. If both the principal as well as the EPC contractor or the critical contractor could have identified this, routed the lines geographically independent, this could have been saved. And maybe the cost for this would have been very less, but 11 hours during a Christmas time, I mean, it's a great thing. So it is beneficial to be proactive risk management. And this is something that has to start from day one of the construction project. Next slide, please. Now, we have established that proactive risk management helps. It helps greatly towards business resilience. And there are three key pillars to proactive risk management, wherein, the principal and the EPC contractor work together in terms of building an asset which will last. Now, one is the EPC contractor needs to understand the client's requirements very clearly. There are business needs for every asset class. And once we understand the business needs very clearly, then there's always a question of, whether the principal should, just comply with, let's say, fire and life safety or property safety, or look at business interruption. Business resilience is encompassing. So EPC contractors need to push clients towards business resilience, but business resilience comes with a cost, and we can only manage what we can measure. So it also falls upon the EPC contractor to kind of put across the table to the principal that, this is going to be the incremental cost for you to become business resilient. This is going to be the cost for fire and life safety, and let them take an informed decision. So it starts with the client requirements, understanding client requirements and giving them the cost benefit analysis. From there on, there is always, what code needs to be chosen to let's say, go into the client needs. Now it can, starting with the law of the land, which cannot be bypassed. Then there are model codes like IS codes within India, which also give certain guidelines for a lot of construction aspects. And there are proven performance-based industry-specific standards. Very good example is, let's say there is a greenfield project for a pharma industry or a food and beverage industry or a cold chain. There will be requirements for pristine environment, which can be achieved with insulated panels. Now, let's say the local code says we need a non-combustible construction, but you cannot have, let's say, a rock wool panel or a glass wool panel. You might need some plastic insulated panels, which goes against non-combustible construction. So local codes and model codes are not helping, but we can look at global practices, put in place panels which have acceptable fire and smoke spread characteristics. Now, there can be an incremental cost because of this, but are we meeting the intent of business resilience? This will have to come through what codes we are choosing to attain what the client requirements are, and there should never be a mixing of codes. And last is the principal and the EPC contractor will only get one chance to build the asset the right way, and once we miss the bus, we miss it for a lifetime. So there should be no retrofitting requirements. It again starts from day one in terms of conceptualizing. So proactive risk management from day one will help build an asset where the costs are also under control, the intents of the clients are met, and there is no retrofitting requirement. Moving on. Once, let's say, the construction starts, I mean, these are basic hygiene requirements. Everybody is aware. So whatever is in the EPC contractor's control, I'll just touch upon three critical points listed here. One is ignition source control in terms of not letting a fire starting at the construction site, and always keeping away the combustibles with good housekeeping practices away from the ignition source. And last is, whatever controls you put in place, you should have some form of feedback mechanism that will give you an indication if things are working at site. So having a regular safety and loss control audits at the construction site is going to help reduce the frequency of losses happening at a construction site. Moving on. So Marsh has global capabilities to help during project stage the EPC contractors as well as the principal for business resilience and to build an asset that can last for a long time. Now, you can think that there can be a duplication between multiple consultants, architects, PMC contractors. We specifically look at property damage risks as well as business interruption risks, something like giving you an insight of what happened in Atlanta's airport, which could be missed. And if that goes into the operational asset, I mean, it can impact the business resilience. So we can be there from day one, help you quantify, put in place engineering measures to reduce risks. So we can be there to help you on the project risk consulting front. And with climate change, NatCat is also coming. So for all assets, even before they are created, we can provide you with the NatCat profiling of what are there and what best could be done to mitigate any exposure. Next page. And for any over-dimensional cargo during the project phase, there are a lot of risks in the journey. So we can map that out for you and help you put in place mitigation measures for over-dimensional cargo for projects. So these are areas in which Marsh can help, and we have global expertise on this. Over to the next slide. So I'll leave the dais to Abhishek with this last thought that, we all hope for the best, and principal and EPC contractors should also prepare for the worst, and that will help you become more resilient. It is a partnership. Thank you.
So thank you, Harish, for the wonderful session. We could not agree more from the note that the best also prepare for the worst. And I'm sure that all our clients intend to be the best in their sector by adopting the best risk management plan. Now, I will welcome Mr. Richard Gurney, Global Head Construction, Marsh Specialty, to share his thoughts on the topic we have discussed today and also enlighten us with his views on construction sector. Over to you, Mr. Richard.
Thank you, Abhishek. Great to be here. And thank you to all of our excellent presenters today. Before we move on to questions, I just wanted to consider the background to today's and future events. As Sanjay started, today marks the beginning of a series of quarterly webinars that Marsh India will be hosting that address some of the more complex and challenging areas of contract formation and language, and how this interfaces with the requirements of the insurance market. These are critically important subjects and can make or break the financial viability of some projects, and highlight how the interaction between the construction and insurance markets is so important in the context of construction activity. These webinars are very timely, as Abhishek touched upon at the beginning. As you will know, earlier this year, Marsh and our sister MMC company, Guy Carpenter, released a report written by Oxford Economics entitled The Future of Construction. Our aim was to highlight the extent of the opportunity in the construction sector, both to the construction industry stakeholders and to the construction insurance industry alike. The findings were fascinating. As Abhishek mentioned, construction expenditure globally is set to increase by 42% to $15.2 trillion by 2030. This will be driven by population growth, urbanization, and the corresponding demand for social infrastructure. The sector over the period will average 3.6% growth per annum, which will outstrip both manufacturing and servicing. But we'll see profound change within the industry too. Zero emissions targets will drive huge demand within the sector around the world. We'll see the emergence of a relatively new area, that of deconstruction, and focus on brownfield sites. We'll see the increased adoption of what's been called modern methods of construction, robotics, 3D printing, modularization, and various other areas. We'll see the increased adoption of digitalization and the use of data to inform decision and design. And we're going to see a change in workforce profiles right around the world as we see scarcity of skilled resource impacting our ability to embark on all the construction we're going to see. This period of growth will be most evident in India. India will surpass the US as the second largest contributor to global construction growth after China. India will become the third largest construction market overall in that time. And the sector with the largest growth rate within this will be infrastructure, where India will be the fastest growing economy anywhere in the world with an annual growth rate of 9.8%. As I mentioned at the beginning, the timing for the launch of this series of webinars is not by accident. It is a recognition that India will see historic construction growth, attracting huge inward and domestic investment, adapting to and adopting the technological innovation that is already sweeping through the sector, and welcoming international participants eager to partner with domestic stakeholders. The insurance industry, as it has always been, will be a partner to that growth in the construction sector, an enabler of change, innovation, and economic prosperity that will be a consequence of the substantial investment we will see. Marsh is absolutely delighted to partner in this exciting growth trajectory, providing advice on risk financing, management and transfer, advisory support, and innovate and insurance solutions of all types. Abhishek, I'll pass back to you for the final section, which is question and answer. Thank you.
Thank you, Richard, for the closing remarks. I'm just conscious of time. And we have received a couple of questions in the chat bot as well as in the question answer session. Considering the time limitation, I will be taking a couple of those questions. However, whatever questions are left over, we will definitely be answering to that via separate emails. And if in case we are not able to take up your question, please feel free to write to us and ask those questions. We'll be happy to take it over. My first question is from Mr. Nitin Nair. This question is regarding cessation of work cover. In case of force majeure, for which the insurance generally give a very limited cover or excludes, how do we need to build our insurance policy so that the requirement of cessation of work can be taken over? I believe, Stephen, would you like to take up this question?
Yes, certainly. The insurance programs, sort of as they exist for construction, respond to physical loss or damage. So in essence, when I'm talking about cessation of works, and a lot of that was COVID related. So when COVID occurred, there was no real physical loss or damage. So no real trigger for the traditional construction insurance market. Now, we are aware that some clients or some project owners had a desire to deem that there was physical loss or damage in order to pursue a delay in startup claim. So there was a vested interest to demonstrate that damage so they could have what is the business interruption cover. Now, that's probably not of too much interest for contractors. Now, in terms of cessation of works, if that results in a delay, at this point in time, there is not a liquidated damages insurance solution that is readily available. There is a small number of markets that are prepared to consider writing that business, but on a very, very selected basis. So there is something available, but very selective. And I could perhaps go back, showing how old I am, maybe 20 years since liquidated damages was readily available in the market. But at that point in time, when it was available, the premium rate was what we would call as 10% rate online. So if you wanted to buy $20 million of cover, it would cost you $2 million. So it was expensive then and got to the point that it was not viable for the insurance market because they're still losing money at that price. So yes, there are solutions, but on a very selected basis for very selected clients across a portfolio of risks, as opposed to an individual not so good risk.
Thank you, Stephen. I'll be a little quick because we have crossed 15 minutes over the time. There is a question which is marked to John, which talks about testing and commissioning. When it is done, handover is over, but still the client has not capitalized the assets in their books. How would the insurance behave in this particular way? Do you think this is something which is common? And what will be your answer? Very quickly, John, can you address this question?
Very quickly, I would suggest that the capitalized comment is more an accounting issue rather than insurance interpretations. Again, I would say it's an operational loss, but again, every single circumstance needs to be looked at in terms of proximate cause. Did it manifest during construction? All of those variables. However, right now, based upon the simple analogy that all of the criteria has been met, the testing commission has been completed, and it's been successfully handed over, it should be an operational loss, theoretically.
Great. Thanks a lot, John. Thanks. Bratiti, I have seen your question and I believe it has already been answered by Stephen. And in the interest of time, I would not be able to take any further question, but I would definitely encourage all the participants to please write to us in case they have any further questions. With this, on behalf of entire Marsh family, we thank you all for participation and wish you all a very pleasant evening and the rest of the day. And thank you to all the speakers. Thank you.
Thank you.
Thank you.
everyone.
Thank you.
Thanks a lot.